Okay, let's do this. Mr. Mash here. Welcome to the second part of our private debt section. And in this section, we're going to focus mainly on high yield bonds, the junk bonds. And also we are going to focus on convertible bonds. Yeah, the bonds that can be converted to equity. They have that option on them. All right, let's get right into it. I hope you enjoy this session. Firstly, on high yield bonds, I'm going to go through this, and for you to understand this, I'm going to make a comparison between high yield bonds and leveraged loans. Because remember, both of these are part of what we refer to as mezzanine debt. Your high yield bonds are issued by sub-investment grade borrowers. Often they are issued by the holding company, not subsidiaries or anything, but by the holding company. And also with leveraged loans, these are also issued by sub-investment grade borrowers. And already remember, with leveraged loans, these are usually issued by firms that have high levels of debt already. All right, and the term for high yield bonds is between 5 to 10 years. For leveraged loans, the term is typically going to be shorter. For security purposes, the high yield bonds are subordinated. The leveraged loans are senior or junior secured. High yield bonds are going to be more liquid because they can be standardized. Leveraged loans are less liquid and they are more bespoke, which means they are more tailor-made. These are going to be highly tailored in terms of their covenants and other terms of the loans, but these ones are going to be standardized, the high yield. So these are tailored, just in case you don't use this word often like me. They're tailored and they are going to be unique. In terms of indenture features, the high yield bonds, they include covenants. They sometimes lack maintenance covenants, but they would include restrictive covenants. And for leveraged loans, these ones actually have a maintenance covenants. What is the difference between maintenance covenants and the restrictive covenants in high yield bonds? So your maintenance covenants, these are going to be based on financial performance. So these covenants on maintenance, these are based on financial performance matrices. These are based on financial performance. And in terms of your restrictive covenants, so your restrictive covenants, these are going to be specific to borrower actions. For instance, if you have a negative pledge covenant, this actually limits the sale of certain assets or acquisition without the lender giving consent. This is example of restrictive covenants. Or anything that has to do with change of control, like the acquisition that I gave an example of. This has to be done with the consent of the lender if they get into this restrictive covenant. But if there's a maintenance covenant, they have to maintain certain ratios. For instance, they want to keep their leverage ratios low. They decide on a particular figure that the lender and the borrower agree on, and they put that as part of the covenant. Change of control clause. In high yield bonds, they require issuer to repurchase bonds at a fixed price if a predetermined percentage of voting shares is acquired. And change of control is not typical in leveraged bonds. So change of control is not a typical feature of leveraged loans. And then in terms of callability, high yield bonds, they come almost all the time with a call option. Okay, and the call protection period is up to half of the bond's maturity, and issuer pays a premium above par. The issuer pays a premium above par in terms of callability. And for leverage loans, these are payable at any time and usually with no premium. So usually these are going to be paid at par. Investor call protection is typically 3 years of the call option. So from 3 years going on, that's when you have the call protection for high yield bonds. And there's no similar call protection feature in terms of leveraged loans. The call option impact on prices, it lowers the bond price for high yield bonds due to the value of issuer's call option being embedded in the price. But for leveraged loans, remember leveraged loans, these usually follow a floating rate. These follow a floating rate. And this floating rate can be the market reference rate, and a quoted margin is added to the market reference rate. Because of this, there is no premium on these leveraged loans. But however, we can say that these leveraged loans are called at par, because their value is always going to adjust and to always be close to the par value. So they will be called at par, which is why it's not applicable to say they have any options that would put a premium on them. Okay. And then the coupon rates, they are higher for non-callable high yield bonds with similar maturity to compensate for the core future. So if there is no core feature, it's non-callable, they are compensated by getting a higher core rate. And in terms of leveraged loans, this is floating and in line with what is happening in the market, any changes in the market. The value of a callable bond is given by the value of a straight bond minus the value of the issuer call option. So for a callable bond, the value of a straight minus value of a call option. Okay, which means a straight bond is always going to be more valuable than the call option, than the callable bond, because you subtract the value of the call option. The leveraged loans are not priced with an issuer call option, so there's no call option here. They are not priced with the issuer call option. In terms of incurrence covenants, you're going to have these restrictive covenants, which we spoke about. Remember, we said high yield bonds, they lack maintenance covenants, but they have restrictive covenants, and this could limit dividends. They impose limits on dividends, or to say for a certain period you don't pay dividends. This could limit taking on any additional debt or any asset sales. When we spoke about the asset sale, we said this is what we refer to as a negative pledge covenant. Negative pledge covenant. Okay. Which is a restrictive covenant. So all of these are restrictive covenants which are part of high yield bonds. But for leveraged loans, the covenants are more flexible, and they are maintenance covenants which have to do with financial performance. Okay, so they are more flexible with leveraged loans. And issuer decision on the call, this is based on the issuer's ability to refinance at lower cost for high yield bonds, and for leveraged loans, the prepayment may happen at any time based on the company decision. So prepayment happens anytime based on the company decision. All right. So that's a comparison of the high yield bonds and leveraged bonds, which I made a comparison here so that you get to understand how your high yield bonds are going to be different from leveraged loans. But you should understand that these high yield bonds, they are longer term. They have mostly restrictive covenants, like the negative pledge covenant. They have a core protection on them, and because of the core protection that is on them, these can be called at a premium above par, whereas leveraged loans, they are only called at par because they are always going to be in line with the market reference rates. All right, and there is no call option on leveraged loans, so they are not priced with a co-issuer, with an issuer call option. However, the high yield bonds, the value is that the value of the straight minus the value of the issuer gives you the value of the callable bond. All right. Now, looking at this example, we have Everfloat, and we are comparing the high yield bond versus a non-callable fixed rate bond, where we have this proposed value of 9% on a 7-year yield bond, We are also told, this is something you're familiar with from your level, from your level 1, to say if you have this interest rate at time 1, the lower interest rate, if you have it, you can calculate this lower interest rate. If you have this, you can calculate the upper interest rate by taking this lower interest rate and then you multiply by e to the power of 2 times the volatility. Okay, and then you make a couple of assumptions like the log normal random walk process, and also the e is the natural logarithm, which is the Euler's number, which is a base, which is a natural logarithm. All right, and it's a constant 2.7. In this instance, we make an example that the volatility is 10%. Then we calculate these values. So we start with an initial interest rate of 9% in period 0. And then in time period 1, when we move to time period 1, this is shown on this binomial tree. We are given this, the power value is 100, 9% in one period. So to get these values now, that's where you use these formulas. For instance, to go up here, you take the initial 9% and then you multiply by the Euler exponential to the power of the volatility minus the volatility squared over 2. That's how you do that. Okay, so, and you do the same when you calculate, this is at the top part, at the bottom part, you use the negative of sigma. So this is done here, and you can check out these numbers for yourself. But when we are going up, the interest is going to be 9.897, down 8.1, and they go up or down with equal probability. Okay, and then to now get these values in period 1, what you do to get these values, you're going to take, it's explained that that is in 1 year, the remaining 6, you have remaining 6 years, right? And these bonds, they commence 6 months from now, and they are semi-annual bonds, which means if it commenced 1 year from now, you have 6, because initially it was a 7-year bond, remaining 6. So 6 times 2 will give you your n, which is equal to 12. Which is why when you calculate the present values now, you use the probability. When it goes up, this is the interest rate, you divide it by 2 because they are semi-annual, and n, you put 12 in your financial calculator. So your n is 12, your IY is equals to 9, it's 9 point, yeah, it's 9.897 over 2, which is equals to 4.9485. You put this in your calculator, and the payments are 9% over 2. You put 4.5. So you then compute the present value. The face value of the bond is 100. It's given here. You compute this, and you must get 96.014. And with the value going down here, you're going to also use this value that you calculated for the interest. You divide it by 2. So which means when you compute this, the interest here is going to be 0.813 divided by 2. You should get 4.0515. Okay, and then the other values should be the same. The n is 12, the periodic payment is 4.5, the face value is 100. You must get 104.97. Okay, then you can extend this period using this formula. These formulas, we be familiar with them from, I don't think we are going to be using these formulas a lot. It's something that is given. You must know this by now. So if you need to use it at any point, they'll be giving you this. It's not necessarily, but it's something that you remember after doing this so much in the second level. If you've never done this, just take a look at it and do a bit of practice on that. Okay. Now, look at the first question. Discuss how the bond price and yield outcomes shown in Exhibit 9 would differ in the case of Everfloat's high yield bond. So this is Exhibit 9, and in the case of the high yield bond, high yield bond, I took an extract from the exhibit. They tell you that there's a core provision on the high yield bond, and Everfloat Holdings may redeem some or all of the notes on any business day before maturity, starting 3 years after settlement, based on the core price schedule as a percentage of principal amount plus accrued interest. So you see here that the core price schedule for year 3 to 4, is 104.5. So if you come here and you look, you're going to, if it's a call option, I always remembered this by saying core C, and then it's a ceiling, C for ceiling, which is a maximum value you must not exceed. If it was, on the other hand, if it was a put, which is not the case here, I'd say put down, and then I would put a floor, which is a minimum value. Yeah, that's how I tried to remember this. It's a ceiling here. And this ceiling after year 3, after 3 years, is going to be 104.5. After 3 years, it's 104.5. So you look at these values here, and what you're going to see is that this value exceeds our ceiling. So they change this value. They change this value to 104.5 because the bond is called at 104.5. So the value of at which the bond can be called is 104.5 from years 3 to 4. All right. So what you get to see is that this value at which it's called is lower than the actual value that you would have calculated for that third period. Okay. And when it's called here, it's called at a lower price than the callable bond. I hope you get basically this high level explanation on why we change this value. It's a ceiling, and because it's a ceiling, we must not exceed this value that is given in terms of their core provisions and their pricing schedule. All right. So let's move on to the next one. Evaluate the effect of a high interest rate volatility on the price and yield outcomes from Exhibit 9. So you're also going to see from this that when you have your higher volatility, you end up having high prices. When you have higher volatility, you end up having higher prices, and two of these are going to exceed in year 3. Remember, the ceiling from year 3 for 4 years is equals to 104.5. So none of these prices must exceed 104.5. Okay, and which therefore means that for any prices that exceed 104.5, like this 105, you remove it and they replace it with 104.5. Same with 112, this should also be called at 104.5. Okay, so what this basically tells you is that when you have higher volatility, the bond is going to be called at these two lowest yield outcomes. At these two lowest yield outcomes, this is where the bonds are going to be called. Okay, just remember this. For any embedded or standalone option transaction, the value of the call option in the high yield bond increases in value as the interest rate volatility rises. So as the volatility on the interest rate rises, this is also going to increase the value of the call option. The value of the call option value. Okay, and we said the value of the bond, okay, the callable bond, value is given by the straight or non-callable bond value minus the call option value. And you see that if the volatility is increasing for any option, whether it's a put or call option, the value of that option is going to rise, right? And as the value of this option rises, this becomes bigger, right? If the number you're subtracting becomes bigger, it means this whole thing as a whole is going to go down, which is why the value of the callable bond is going to decrease. Okay, so that's question number 2. Let's look at these analytic durations. So analytic durations are theoretical. They are going to be theoretical in nature. And the duration, we are simply going to be comparing what happens to the price of the bond when there's a change in the yield rates. Okay. In this instance, you see that with the duration, you are going to have two effects. The linear effect, which is the slope, the change in price over the change in the yield rate. And the second order effect, if the value of the bond is shown by this, right? The second order effect is going to show the effect of the change in the curvature. That's the convexity. The change in the curvature is going to be reflected by the second order effect, which is sort of like the second derivative with price with respect to the yield rate. Okay. So when you have bonds with options, what this means is that the future cash flows are uncertain. Future cash flows. And when this is the case, the most effective measure for this is the effective duration. So always take note of the fact that your effective duration is going to measure the bond sensitivity to changes in interest when you have embedded options like your callable or your put bonds. So effective duration is effective when we have options on our bonds, and your effective duration is going to be calculated using the change in the price, downward movement, minus the up, divided by 2 times change in curve, multiplied by the original value there. Okay, so this is how you calculate the effective duration. I just quickly wrote this formula, but you must be familiar with this formula here. This effective duration basically involves pricing the underlying bond or loan given an instantaneous parallel shift in the issuer specific yield curve. Okay, so this is where the change in curve comes in. So this is a parallel shift in the curve. With the price increase, this is a result of the price increase, and this or a price decrease, effect of a price decrease, effect of a price increase from the initial price P V0. This is the initial price. So that's how you get the effective duration. Okay. And when you look at callable bonds now, if you look at this one, you have an option free bond here, and you have the embedded call option value. This is the callable bond. The value of the callable bond is always below the value of the option free bond, because remember, the callable bond price is given by the value of the straight bond minus the value of the call option. Okay, which means the value of the call option, because of this value of the call option, you're always going to have the value of the option free bond, this being always on top of the value of the callable, because to get the value of the callable bond, this one, you have to take this option free and you subtract this call option, where this is the call option value. Okay, where this is going to be the call option value. All right. So for this type of callable bonds, you can calculate the effective spread. The formula is very similar. The effective spread duration, the formula is very similar to the one that we calculated for the effective duration. This is again the price, the value resulting from a negative price movement and the value resulting from a positive price movement divided by 2 times the change in spread times the original value here. So the change in spread replaces, you see here, it replaces the change in curve. And this will be the situation for, this is the situation for leveraged loans. This is the situation for leveraged loans, because the value of leveraged loans is not affected by change in curve, but they are going to be affected by the change in the spread when the market conditions are changing. Okay, so let's look at this example here, where you have we're continuing with overfloat, and just read through this and then we'll discuss it just now. Okay, so you are given leveraged loan and high yield bonds have features which differ from non-callable bonds. As a starting point, she calculates, this is Supak, she calculates effective duration for both the non-callable and 7.4 5-year bond and 9% 7-year bonds priced at par for the change in curve of 0.0005. Okay, so she calculates this formula, you know, remember we said this is just effect of change negative positive over 2 times change in curve times the original. Okay, so when she does this calculation, she gets the effective duration of 4.117, and for the 9% 7-year one, she gets an effective duration of 5.11. The question is to discuss the relationship between the interest rate sensitivity of the non-callable 5-year bond and the proposed leveraged loan for the Boatswain acquisition. Okay, so we are going to compare these two, and should there be a change in the market reference rate? This market reference rate is the one that mostly affects your leveraged loan. This is the one that mostly affects your leveraged loans. And this will result in the adjustment of coupons. So the coupons are going to be adjusted, because remember, the coupons are going to take the face value of the bond and then you multiply by the marginal reference rate, and then a quoted margin is added to it divided by the number of periods. All right, so if this changes, it adjusts the coupons. The coupons are going to be adjusted. Okay, but however, the market reference rate, you find it both in the numerator and the denominator, and the discounted margin would likely adjust to changes in the market, which therefore means for leveraged loans, you're not going to see a huge change in the prices. Always remember, with leveraged loans, they're always going to be trading very close to par or at par. They adjust to changes in the market conditions. All right. But for the non-callable bonds now, the bond price will change given the change in benchmark yields and spreads. So you're going to expect the fact that these non-callable bonds are more sensitive. So the non-callable bonds are more sensitive to interest rate changes as compared to the leveraged loans or the callable bonds. Okay. All right. So this is in high level explanation on comparing the non-callable bonds and the proposed leveraged loan. Okay, the leveraged loan, the value does not really change much. It's can be repaid at any time, and it trades close to the par. The price is always around par as there are adjustments to the market reference rate. But the non-callable bonds are going to be more sensitive to changes in interest rates than the leveraged loans. All right, let's look at the second question. Discuss the relationship between the effective duration of the non-callable 7-year bond and that of the proposed Everfloat 7-year high yield bond. So I want to compare these effective durations. If we look at this, so this is something that we showed earlier, where there's a price here, and this was our yield. And we showed that the non-callable bonds are going to look like this. These are option free. And the callable bonds are going to be like this. This is the callable bond. And you see, for lower yields here, you're going to see that they are not so sensitive. The callable bonds are not so sensitive because they are going to be probably called at a particular price here, and they are limited. The upside potential is going to be limited for the callable bonds here because they can always be called back as the prices continue to increase. Okay, you would see that at these lower yields, you have the option free bonds are steeper and the callable bonds are less steep. Okay, so for interest rate changes, these are going to have a smaller effect on the callable bond because for the callable bond, you see this is less steep here. So any interest rate change has a relatively small effect on these callable bonds on the price. It doesn't change much, but because for the option free bonds they are steeper, hence there is a bigger impact on the change in interest rates. And this is because at lower yields here, remember the yields are lower here and they increase in this direction. Okay, at lower yields, the price appreciation is going to be limited for the callable bonds because there's a possibility that the issuer can recall these bonds at a predetermined price. Okay, so that's how we are going to explain this. Okay, I hope you understand that. Let's move on to the next one. So, generally speaking, when we compare non-callable versus high yield bonds, the effective duration, which we said is more useful when we are dealing with bonds with options, the effective duration of a non-callable fixed rate bond exceeds that of a high yield bond due to the issuer call option, which gains value as the yields fall. So as the yields fall, the issuer call option gains value. You saw that this, I mean, if you can remember this graph, it's going to be very helpful for you because you see the difference with the callable as the yield decreases in this direction. This gap is the value of the call option. And this value of the call option increases as the yield falls. As the yield falls, the value of the call option is going to increase. Okay, and because of that, the effective duration of the non-callable, this one, is going to exceed that of the high yield bond. All right. So because the high yield bond has a call on it, and this one has no option on it, it's option free. So this is important. So remember the issuer call options gain value as yields fall, like I seen here, is the issuer. This distance continues to increase as the interest is falling, because the interest is falling in this direction, because the issuer can refinance the bond at a lower interest, reducing borrowing cost. Leveraged loans and interest rate sensitivity. The price sensitivity of leveraged loan is tied to yield spread changes due to periodic marginal reference rate reset affecting interest expense and income despite limited price sensitivity. Okay. In on-market conditions and bond price movements, the high-yield bond prices can deviate from model predictions, especially when there is financial distress and there is a market flight to quality where risky assets decline and government bonds rise. So when the market is in distress and the capital is flying to quality, risky bonds are going to decline, but government bonds are going to rise. Then in terms of empirical or analytic durations, in practice, they use empirical durations. This is based on data. So they use historical data. And by doing historical data, they can run regressions on historical data, run them against the benchmark. Okay, but with analytic durations, these are the ones we're talking about, the modified durations and the Maclaurin durations. These ones are analytic durations. So practitioners use empirical duration models due to observed negative correlations between high yield spreads and benchmark yields. So there have been observed negative correlations between high yield spreads and benchmark yields. Hence, they use empirical durations, which runs regressions and uses historical data. Okay. Now, with convertible bonds, these are bonds that can be converted. Either you choose to convert them into equity or shares, or you keep them as fixed income. You will see from this diagram that with the convertible bonds, the issuer share price rises, the nature of the bond is going to shift from being, you see here, it will have fixed income features, and the further it moves to this side, it's going to have equity features. When you have equity features, right? And in panel A here, this is usually given. This is the value of the bond and the convertible value. They are very low. The equity value is very close to zero. This is going to be zero here. And as we move, as the share issuer price rises, so here the share issue is very low, and in these periods here, this is usually when you have your startups. These do not have any financial history, and it's quite low in value. The company is still starting out, and as the company grows, the value of equity increases. The bond value will initially increase until it reaches a fixed point. The value of conversion continues to rise as the value of equity also rises. Okay, so when you get to B, the value of the bond is closely aligned with expected interest principal payments. So, and the bond value, both bond value and equity value are rising, and they are not far apart from each other. But when you get to C now, where you get, remember this is equity like features or characteristics, this is fixed income. In between here, this is the hybrid case. Okay, and then in the hybrid case, the share price is very close to the conversion price or the conversion rate. The share price is very close to the conversion rate. The issuer share price rises above the conversion price. The convertible bond price approaches the equity value. So when you get to D now, the conversion value now gets closer and closer to the equity value. And as the issuer share price continues to rise, the conversion price and the convertible bond price approaches to the equity value, and it will be better at this instance now to convert. All right, so you just understand this diagram, that the bond value is limited and it becomes stable at some point, but the conversion value continues to rise and almost becomes the same as the equity value as the share price, issuer share price, also rises. All right, let's do a couple of questions before we wrap this up. I want you to just go through this diagram, right? Go through this diagram. There's nothing new here. You know most of these things. In terms of convertible bonds, I said they are in the growth stages. They are popular here because they want to attract investors. People might not be willing to invest in these startups, but when they see this conversion option, they then want to convert. There's an equity upside. If the equity gains, they can convert into equity, and it is going to appeal to risk-averse investors. Remember, we said when they put warrants here, it's going to attract investors because these are sweeteners. They would want to then have that option to convert when they have this right to convert, not an obligation. And there's this upside that comes with taking on these warrants. Okay. And then the interest rate sensitivity. The standard measures of interest rate sensitivity are not applicable to convertible bonds, like the ones we're talking about, the effective durations. The bond is senior unsecured. There's no collateral because they're in their growth stages, in their startup phases. So collateral is not there. It's unsecured. The firms don't have a lot of assets. They don't have much history to talk about. There are no financial covenants. There are lower coupons, and they are non-callable. There's less liquidity, and there could be a change of control protection using what we also refer to as the ratchet. I don't know if you remember the ratchet, which is like anti-dilution. Anti-dilution, okay. This is the protection against the dilution. The ratchet is going to be, yes, in terms of conversion rights at discounted prices in the event of dilution. The ratchet is going to apply here. Then the change of control, if there's been any changes to the ownership of the company, this change of control protection is there. These clauses are there to protect investors from any changes in ownership of the company so that they're not disadvantaged. So the questions I spoke about, you can pause, try them by yourself, and then come back. We'll come back if you did that. Which of the following statements describes a typical contingent feature of leveraged loans? The leveraged loan is callable at par. So this is correct. They're always going to be callable at par. We don't usually refer to leveraged loans as callable loans, but their value is always aligned to, because they are in line with the market reference rate, right? So they're always very close to the price is always close to the par value. Loan is callable at fixed price above par. Anything above par, these are high yield bonds. And loan interest may be paid in kind. This is generally happens with almost all mezzanine debt. Okay, so answer is the most appropriate one. Number 2, an issuer has decided it makes the most sense to repay an outstanding leveraged loan versus other outstanding debt obligations. Which of the following is most likely reason? So they want to repay the leveraged loan. The reason this could happen is that the discounted margin has decreased. So remember, if you have the discounted margin, when you calculate the price of, you have the coupon rates, which are calculated by the marginal rate plus the quoted margin here over M multiplied by the value here, the face value. And then at the bottom, that's where you have the discounted margin, also added to the marginal, and then over M. If this discounted margin has decreased, this increases the price. And in this instance, it will be wise then to repay the outstanding for the leveraged loan. Okay. So A decline in the discounted margin occurs because the issuer's credit quality has improved. If the issuer's credit quality has improved, if you repay, you can then take another loan at better terms. If that is the case, we spoke about an increase in credit quality. And an increase in credit quality implies better terms. Okay, question number 3. Suppose you observe two bonds that are identical other than two characteristics, bond value or coupon. Which of the following statements best describes the likely relationship between a callable high yield bond and an otherwise identical bond without a core feature? So this is also very straightforward. The answer is going to be C. Callable bond has lower value or higher coupon. Remember, a callable bond has it's like this. That diagram I showed you, okay, this is callable and this is option free. So the callable bond has a lower value. The value of the callable is always going to be below the option free bond. The value of the callable bond is equal to the value of the straight bond minus the value of the call option. Because of this, subtracting the call option on the value of the value of the callable is always below. All right. And then number 4, the price yield sensitivity of leveraged loans and high yield bonds are usually best measured by which of the following duration measures. So this is quite straightforward. We said for the high yield, it's going to be we have the leveraged, we said we use the spread because they're not affected by yields. And then high yield bonds, these are affected by yields. We use the effective duration. The effective duration is when you get these changes in the price, in the value, upside and downside over 2 times the change in the yield, right, times the original one. But in this instance, for leveraged loans, instead of using change in the curve, we use the change in the spread. Okay, discuss features of convertible debt that makes it an attractive financing choice for early stage growth companies as compared to leveraged loans or high yield bonds. So for early companies, they want to raise this debt, but they don't have any collateral, no assets yet. So by putting convertible bonds, it attracts investors. They want to invest there because they know that at some point, if the company is successful, there's a huge upside in the sense that if the company does really well, there's unlimited potential in terms of how much they're going to get. So the convertible bonds, they offer equity upside in the form of conversion rights to investors otherwise unwilling to lend to firms with less stable cash flows and few assets to secure the debt. Okay. And in contrast to both leveraged loans and high yield bonds, convertible debt is typically senior unsecured with no financial covenants and a debt coupon well below that of non-callable bonds. So those are the points that you need to take into account. All right. And then I want you guys to take a look at this case study on Kummersted. This is going to help you understand some of the calculations with regards to convertible debt. Okay. But one thing that you have to remember is that the conversion ratio is given by the convertible bond value divided by the conversion price. And in our case here, we see that the convertible bond value is given. So the convertible bond value is given as 1,000. And the conversion price here is given as 275. If you divide 1,000, you're going to have the conversion ratio is 3.64. Okay, you get that is 3.64. And yeah, 3.64. So if you have an owner, that is 1,000 1,000 bond, they can redeem this for 3.64 shares of common stock during the conversion period. The conversion value is going to be given by the conversion ratio, this one, multiplied by the current share price. Okay, is going to be given by the conversion ratio multiplied by the current share price. Okay. And then, yeah, so I want you to read this for yourself and be able to answer it. Discuss the payoff profile of Kuma test convertible bond under different possible scenarios at the time of maturity, assuming no additional financing or case. So at the time of maturity, there are two options. Either the share price is less than the conversion price, or the share price is greater than the conversion price. Okay. If the share price is less than the conversion price, then the share price is going to remain below the conversion that we got of 275 per share. Then the bondholders will then just receive the face value which was given in the case study of 30 million. They're just going to receive this amount. Kuma test is considered 30 million convertible debt. This is what they receive if the share price is below the conversion price. But however, if the share price goes above the conversion price, they're then going to convert. And if they convert, then the conversion value is going to be calculated using the conversion ratio multiplied by the current share price. Okay, it's going to be calculated using the conversion ratio times the current share price. We calculated this conversion ratio is 3.64, and suppose that the current share price is 400. Okay, for instance, if you calculate this, what this means is that all the bondholders are going to receive 1,456. Okay, that's how you get that. And then the second part, discuss the fractional ownership. Remember, we spoke about this fractional ownership post, and then we can say this formula was the fractional ownership prior multiplied by the pre-money valuation over the post-money valuation plus the new equity over the post-money valuation. Okay, so in this instance, there's no prior. This is going to be 0. And the additional shares that we are going to get, right? If there's an exchange of all convertible notes for the newly issued Kuma State shares, this will lead to an issuance of 30,000, 1,000 bonds. The conversion ratio was 3.64, and this is going to be, you have 30,000 bonds that they're going to convert to. So the number of shares, additional shares, is 109,200. Okay, and we are given that the existing shares outstanding is 1.3 million. This is there just to save you time. It's here. If you read through this, you will see here 1.3 million is given here, which were divided by, which is the pre-financing shares outstanding. Okay, so this is given, which therefore means the fractional share post is going to be equal to the new shares 109,200 divided by the new shares, because we want the post, right, 20 plus the pre, which was 1.3 million 871. If you add this and you divide, multiply by 100, you must get 7.56% as the fractional ownership. All right, this is going to be the fractional ownership of Kuma test convertible note holders if notes are fully exchanged to the newly issued shares. Okay, so yeah, I sort of went through this a bit fast, but just pause, try to do it by yourself, and then check how I've done the solution. But for now, this video I think has been long enough. Take a breather, take a break, take a shower, take a walk, and then come back. Mr. Marsh is out. I'll see you guys in the next session. Cheers.